For the first couple years of my trading, I was making the same mistake that destroys most traders' accounts. I would see price approaching my level, I would immediately jump in. It didn't even matter if I had an idea of what the market even wanted to do. I was so focused on not missing the move that I kept taking trades based off of incomplete information. And it cost me around 40 to 50 grand when I first started trading. Then I learned something that changed everything for me. One simple rule that transformed my win rate and finally made me consistently profitable. I never enter the market until I see how the market actually represents itself. Now what I think that it's going to be. This isn't just about waiting for structure. This is a shift from trying to predict the future to observing what's actually happening. And once you understand this difference, your trading will never be the same. So in this video, I'm breaking down what I wait for before every single trade that I take and why this observer approach is a part of your edge and how you can start implementing this immediately. So let me give an example of what I think many of you are going through, and you can tell me if I'm right or wrong, and I'll give you a couple examples. So number one, right? We first start what we're looking for to take a trade. What I'm looking for to take a trade is sell side liquidity swept, and I want to target the opposing liquidity pool. So in this example, right, I can see, okay, the market's most likely going to go take sell side. At this point, I'm like, ooh, a long might be coming in here, right? There's possibly a reason we're going to go take buy side afterward, right? There's maybe a bigger time frame for value gap right below us. Now, the problem that happens is this. Low gets taken, market comes back up, and you're like, oh my gosh, I'm ready to take a long. You enter your position, you put your stop at the low, and then the market does this. Stops you out. And you're like, oh, it wasn't ready yet. All right, I got stopped out. And then the market maybe does something like this. Oh, we're finally back up. Oh my gosh, I'm going to take a long. Put your stop in play, and then maybe the market does something like this. Then what happens is the market does this, and then ends up going. How do we read this? First of all, you might be sitting here being like, damn, he called me out. And that's the whole point, is to show you like, I used to do the exact same thing, and I'm going to tell you how you can get around this. This is a main problem of a couple things. Number one, the mindset in which we're in. Our mindset is, I'm expecting the market to bounce and I'm afraid to miss out and get a bad fill, so I'm just going to enter the position without actually the confirmation. And if you are looking for the confirmation or think that there is confirmation, you're actually too zoomed in and you're not reacting to what the specific model is. So what I mean by this is, pay attention when I say this. This that we're looking at currently right now is a market maker model, right? We have sell side of the curve and we have buy side of the curve. Now, in relationship to this model, meaning these highs as the draw on liquidity, I need to see a market structure shift or a break of structure or a change in the state of delivery, right? All the same thing, to validate that we are going through those highs. So let's look through these first couple examples here. People are going to be zoomed in here and they're going to say, oh, the low got taken. Oh, here's my change in the state of delivery. I'm going to take a long. Now, could this end up playing out? Sure, maybe, but it's not in relationship to this model. What is it in relationship to? Let me explain this. The market will do this. We will generate liquidity to then go lower, to then manipulate lower, then break structure, then go take whatever that buy side is, right? So if we are having a break of structure, the break of structure needs to be in correlation to whatever the highs is in which we're generating. If there's buy side liquidity up here, this change in the state is not the one that validates it. This change in the state validates price to go to this buy side. This buy side, when displaced through, becomes the bigger time frame change to validate the bigger time frame draw. So what happens here? You're taking the intraday change in the state that validates the internal move that's not validating the external one. So you're hoping that the market is going to go through it to then validate the external draw, when in reality, a lot of the times this will either, number one, fail because there's the draw and the order flow is very bearish, right? You're trying to snipe a bottom pretty much without the validation of it. Or the market will do this, where we will come up. Hopefully, you're sitting there hoping that the market then actually displaces to get a change, or we'll take this, then come back down, then build price action, generate liquidity, and then have an actual move, right? And what that looks like is this. We generate internal buy side to then actually have the low get taken and then actually displace through the highs that are created. So there's a couple things that I want you to look for when having a high probability reversal. And a lot of people ask me this question, Justin, what time frame do I need to be looking at? What time frame? And a lot of people will kind of simplify it, and I don't think this is bad, but if you really want to get good at trading and recognizing price action, time frame alignment isn't as important as what you think when it comes to, like, if this is a 30-minute draw, you have to take the trade on the 5-minute. If this is a 15-minute, then you should do it on a 1-minute, right? I don't believe in like a match this system where it's this and then you look at this and then this and you look at this. Because guess what? Price action is price action. It's going to be the exact same thing no matter what time frame you're looking at it. It's the same thing. You're just looking at it in a different perspective. It's a magnifying glass. What you need to be able to identify is displacement. Displacement is the most important thing when understanding why you're getting stopped out early, why you're taking trades early, is because you're too zoomed in trying to snipe the bottom without waiting for displacement that's actually in correlationship with the model you are taking. If this is buy side liquidity, I need to see these highs get ran and displaced through to validate this as a move higher. Then I can look at the higher time frames and I can look at the time frames to see where the change in the state is, right? Because maybe on one time frame, this is the change in the state. Maybe on another time frame, this is the change in the state. But when it's an actual change in the state and the market is actually validating that that's what the move is, it will displace. What does displacement create, right? Displacement equals fair value gap. Because when a fair value gap is formed, it is an inefficiency, meaning the market expanded, left room where we did not rebalance to then most likely go rebalance back to, right? So whenever you see fast moves in the market, you'll see a fair value gap open up. So what at the time most likely happens here? We open up a bullish fair value gap that then gets rebalanced into to then continue back higher. That is where we want to be looking to take our entries, right? We do not want to be trying to snipe the bottom, trying to play our idea, so to speak, instead of playing what the market is showing us, right? Wait for the market to actually validate what the market wants to do, because here you're taking 2 losses, 3 losses, and then by the time the actual trade is presenting itself, you don't even have conviction or confidence to actually enter the setup. I'm going to give you an example of what this might look like and show you from today when price ended up actually moving, and then versus how many times you might have possibly taken an early entry off of the idea. So on the bigger time frame going into this morning, I was bearish. We ended up having sell side liquidity here, sell side liquidity here. And yesterday we had a big move lower from this yesterday morning. When we sell off this much, I'm expecting a continuation towards the lows from what we've been having. So when we zoom in this morning and I can say, okay, well, what's going on here, right? If I'm bearish, what do I want to see price do? I want to see price take some sort of internal high. I want to see us generate liquidity in the overnight session, right? So notice these lows that we're putting in the morning. I want to see us go to this 15-minute, show rejection. I want to take a short lower. So if I have that idea, this what might be your thought or like looking at this from a false perspective. Boom, high gets taken, immediately come back down. Boom, I enter in short, stop at the high, stops me out. Why did it stop me out? Now keep in mind, this is pre-market. There's no internal manipulation. There's no confident change in the state. There's no significant swing low that is being displaced through, right? What does manipulation look like? High, taken, displacement. But there's no swing low here, right? When I look at this on the bigger time frame, there's no swing low here that's getting displaced. What are we doing? We're creating the swing low. So the market comes back again. All right, boom, high just got taken. Internal change, right? Let's look at the 5-minute. Boom, high got taken. We're starting to sell back off. Let me take a short. Stop up here. Market's going to sell off. Why is it stopping me out again? Let's zoom back out. Is there a change? Are we displacing it? Oh, now there's something here. Internal high gets taken, but now we have a clear swing low, right? Down close candle, up close candles. If we displace through this, that is what I'm looking for to take an entry. So let's watch this. What does the market do? Oh, we're starting to do it. We're starting to do it, but we're not really getting displacement. There we go. So why is this the timing? What ends up happening here? We generate internal buy side. The market ends up coming up. ES ends up taking this high on NQ. So we have an SMT and we respect this wick. Then we finally end up closing and displacing below this change in the state. Now, another thing that I want you to understand is the market will most of the time accumulate before distribution, right? We'll accumulate, manipulation, distribution, where we accumulate, have one last move higher, where we expect our manipulation leg. That's why ES ends up taking the high and NQ does not. Right? If we look at ES at this point in time as well, you can see ES has our manipulation, right? Where we come up, we take the high. So when I zoom in and I draw this out clearly, you can see what we're expecting to see is accumulation, manipulation, and then distribution to the downside, right? So taking a look at over at NQ, ES takes the high, NQ doesn't. We end up putting in a bearish SMT. This is where I'm looking to take my short, put my stop, and I target sell side liquidity. Market ends up opening. We immediately rebalance back higher to do what? Take internal side liquidity, which again, is another internal model. If you were to zoom in, you can see we end up breaking higher, taking that high, displacing through the swing low. This is another short entry to take at open. And the market ends up selling off and going to take sell side liquidity. So there's a couple things that I want you to pay attention to. And I'm not saying that this might be your problem or it might not be, but even if it's not your problem, this is what I want you to pay attention to. Ask yourself, am I viewing the market in terms of what I want to see? Or what is the market actually showing me? right? When we're very antsy and we want to take a trade and we expect something to happen, right? Like if you're confident about your draw and liquidity, and that's why a lot of people will come to me and be like, Justin, I find myself being right all the time. I have the right bias, but I keep getting stopped out. I keep missing the trade. And the reason in which why that is happening is because you're more focused on the idea versus how price action is actually showing you the idea, because price action is not going to be exactly 100% to what you in your brain is thinking. You have to learn to recognize how it's showing you, right? You have to align yourself with what the market is showing you. Wait for manipulation, number one. Wait for clear manipulation. Another thing to also look for is fair value gaps that get ran through. Notice this entire move here, where we end up getting to this fair value gap and starting to consolidate. Only here do we run the fair value gap to the downside after we have manipulation. And then we use it as an inverse fair value gap. So at that point in time too, it's another thing that we can look for. We want to recognize order flow. And I'm not talking about order flow as in time and sales. I'm talking about order flow in relationship to price action. Fair value gaps get ran through. Notice we continue to hold this bigger time frame 14 or 15 minute fair value gap. Then we run the 5 minute or the 15 minute to the downside. So the more that we can start to align and recognize, does the market want to go higher? And what would the market do if we want to go higher, right? For example, if the market wants to go higher here, what do I think we would do? Well, what we would do is we would probably sweep these lows and we would hold this bullish fair value gap, right? But we don't. We displace through the down close candles and we show a change in order flow. That's why it's called a change in the state of delivery. At that point in time, the market has now validated it. We want to look for a short entry. But here's what I want you to understand. The difference between traders who make it and the ones that don't isn't technical knowledge. It's not about a secret setup or a secret indicator. It's about having the discipline to wait for the complete information, all of the information, before making a decision. Every time you feel that urge to jump into something without knowing and you're fearful of maybe missing out, remember, you're about to make a decision based off of the unfinished story. The analogy I use is like a Pictionary game where imagine you only get one guess. And I start to draw, but you care so much about being right and first that you yell out your answer when you didn't even see the whole picture. And then when I actually finish drawing it, you're easily able to identify it for what it is. Just wait to be able to identify it. This shift in mindset from predictor to observer will transform your trading more than any indicator or strategy. So go practice this. I want you to go look at the recent trades in which you've been stopped out on. If you are not journaling and don't have access to go look at your trades, I'll leave a link in the description to go get a journal called Trade Path. You can start journaling your trades as well and start noticing how much clearer, if you go back and look, the setups that ended up forming if you got stopped too early, and what was the differences between the two when you enter early versus you wait for the clarity. Don't try to guess what's going to happen. There's always going to be more opportunity. I know you want a bottom tick. I know you want to enter a trade. You're like, oh my gosh, it looks so good. I want to take the trade. There's always opportunity. You don't need to rush it. Wait for the market to give you the clear picture. If you do also want personal help with your trading, I bring on students every single month into my mentorship where I coach them, live trade with them. I give them all of the curriculum in which they need. I have a professional psychologist on my team that also is there to help them. If you're interested in getting one-on-one and help coaching with me, I will leave a link in the description that you can go check that out as well. Remember, the market rewards patience, not speed. You're paid for your decision making, not your time. Start being an observer instead of a predictor. I guarantee you, you will be way more successful. I'll see you guys in the next one. Peace out.